In this video, we're going to do an overview of raising capital. Let's start talking about entrepreneurs and venture capitalists. Entrepreneurs bear most of the risk, reap most of the reward. So, of course, whoever gets us started is going to get the most out of it, but has the most to lose as well. Venture capitalists, financial intermediaries, typically limited partnerships. It could come in all kinds of forms. But the point is, they are people that work in between the entrepreneur and the capital. And they themselves may inject capital as well. Play an active role in overseeing, advising, and monitoring companies in which they invest. Generally do not want to own the investment forever. There's a lot more that goes into that last bullet. But in a nutshell, the idea is to get in the ground floor, so to speak, in a new business that has a lot of opportunity, because those first few years, if things go well or even not so well, but it keeps growing, that's going to be like a super growth period. That's when a company really starts jumping up in the numbers. So they want to capture that stage. And what they want to do is once they capture that stage and the business starts normalizing, like more like industry average, then they cash out the super growth gains and they look for the next one. But that's the intent for this. So there's one strategy of investing in new ventures. Stages of financing, you got the seed money. That is just what it sounds like, that initial injection of cash, typically from the entrepreneur himself or herself, family, friends, etc. Then you got the startup round. Then you have the first round of financing, second round, third round, and fourth round. There's a lot of nuance and detail in regards of how that works and how the equity gets distributed around those rounds and how first round financing investors need to be or would want to be protected on their interests for the second, third, and fourth round. Valuations change. A lot of things to go into it, but that's the typical. It doesn't have to follow this necessarily, but that'll be your typical approach. The public issue. This is when a company goes public. So the basic procedure, management gets approval of the board to go public. The firm prepares and files a registration statement with the SEC. The SEC studies the registration statement during the waiting period. On effective date of registration, price determined and selling efforts get underway, and tombstone advertisements used during and after waiting period. This is just in a nutshell to say that they have to get their ducks in a row. This is where regulation starts kicking in, that you have to work with the SEC, and they're going to review it. Now, one thing to understand, approval from the SEC does not mean that you have a good company. It just means the company is organized and the numbers and the paperwork and the reports are done to a minimum standard in order to protect the investor. But it does not mean that it does not represent anything on the risk of the company. It just represents that the management have their things in order at the minimum requirement to meet regulation. Other methods of raising funds, there's crowdfunding. These two are, I guess, newer in the sense of, or the popularity has increased recently in the big scheme of things. So crowdfunding is raising small amounts of capital from a large number of people, usually via the internet. So before, in order to engage in these riskier type of investments for startups and or new companies, etc., you had to be what they call a qualified investor, and you had to meet certain criteria. And it was in order to protect people just throwing money at bad companies, not doing their due diligence, not really knowing. However, at the same time, that was limiting. It was an obstacle for a lot of potentially good companies to access capital. So regulation came out to meet in the middle, where they allow up to a certain amount to do this crowdfunding approach. So it requires a lot less, there are a lot less obstacles for your retail investor, or we call them naive investors, a typical way to say it, where they're not a professional investor, to participate in these opportunities. But it has limitations, etc. Initial coin offering, companies sell tokens that grant the owner the right to use the company's service in the future. It could be a service or a product. You can see this on the internet as well, where instead of they start raising funds, but instead of giving you equity in the company, it could be a combination, but many, instead of giving you equity, they'll do like a pre-sale of the product, give you all the perks and things like that. And it's a way for you to support a product you would like to see go to market, at the same time getting the product before anybody else. Issuance without an underwriter, direct listing. Issuing firms work directly with the exchange. This just means that if a company wants to go sell their shares, for example, if it's a corporation, typically there's an underwriter in between, like an investment bank, between the exchange, like the New York Stock Exchange, NASDAQ, and the company. But that is not necessary. There's reasons to have them involved, because you can do better. It can get better organized and get a better price for your stock, but it's not necessary. We have special purpose acquisition companies, SPACs. These companies raise funds to finance merger or acquisitions with a set time frame. It's cheaper and less time consuming than traditional IPOs. If two companies are going to merge, a new company actually comes out of it. So meaning a new stock and stuff like that. So your traditional IPO may be a little more time consuming and more expensive, versus two companies are already out there. So part of it is because there's a lot of work already done, because these companies are existing concerns. Dual class stock IPOs, unequal voting rights for different classes, allow management to experiment to build stronger business, may reduce management accountability. What this is the same company may have Class A and Class B stocks, for example, and they will have different prices, different voting rights. So you can actually have more than one type of common stock in the same company, and they just have different returns, different risks, different voting rights, etc. The cash offer. There are three methods for issuing securities for cash. This is when you just do it straight cash. Firm commitment, best efforts, does auction underwriting. So we're talking if an investment bank is involved. Firm commitment, that means investment banking says, okay, this is what you're going to get for your shares. And think of it as they are going to buy the shares from the company at a certain price, and then it's up to them to be able to sell it at whatever price they want out there in the exchange. And they just make the difference. But the risk goes to the underwriter. Best efforts, they say, okay, we're not going to guarantee a price. We're just going to get the highest price we can possibly do for you on the market, but the market still dictates. Typically, that's done by commission. So in the firm commitment, they're just getting the spread. They're getting the how much they can price above what they paid for. Best efforts is more of a commission approach. So they try to get the best price they can, because that will reflect on the commission they get, but they will not guarantee it. Now the risks transfers from the underwriter into the company selling the stock. Dutch auction underwriting. We'll talk about that in more in detail later, but generally speaking, it's a type of auction. And the idea is that once they get the bids in, they just rank them and they just go down the list. They'll go down the list on the shares that the person's willing to buy at what price. You see, in this type of auction, it's not just the price they'll pay per share, but how many are they willing to buy. So now the company knows how far down the price range they have to go in order to sell a certain volume of shares. There are two methods for selecting underwriting: competitive or negotiated. Just what it sounds like. You can just go ahead and put your bids out there and people compete for your bid, or you just go ahead and start negotiating with companies. Let's talk about a firm commitment underwriting. As we mentioned before, in a nutshell, the underwriter will guarantee the firm issuing the stock a certain price, meaning that they will buy it for a certain amount and then they'll go sell it to the public. Of course, they will try to buy it as low as possible and sell it as high as possible because they will be bearing the risk. But if what they offer the company is too low, then they might lose that client. So that's would be in the competitive situation or negotiated either way. So they got to be careful. Best efforts, as mentioned before, they say we will not guarantee you a certain amount of money. What we'll tell you is that we will do everything we can within our power to get the highest price possible for you on the stock market. And we'll just get a commission from that. The risk is on the company now, not the underwriter. As we mentioned before, what they do is they receive bids from various people, various institutions or organizations or big investors. The bid will come in with a price and a volume, as in how many shares they're willing to buy. And what they do is they say, okay, when you even want to sell so many shares, they just go down that list. They put them in order of price, and then they start going down high price at top. And then they're just going to look down and start adding up how many shares those people are willing to buy. So once they go down to the bid, that cumulatively speaking, all the bids above it also add up to the amount of shares they want to sell, then they'll pick that price because they know that everybody from that point up is willing to buy that many shares for that price. So the people that bid a higher price get a benefit because they will be actually paying a lower price than they were willing to pay. Investments banks, these are what they do, the underwriter. So you hear those two terms a lot, but they're pretty much the same person in this do it for this discussion. Perform critical functions, help determine type of security, method of sale, and offering price. So these are the experts. They take a look at your company, your industry, and what's going on in the market conditions out there. And they say, well, if you do it this way, this is under the current market conditions and the type of business you're in and your industry, this is the combination of, oh, this is the strategy that you want to follow to try to get the best price possible. Typically, they sell securities typically using a syndicate to limit risk. Syndicate just meaning that there might be more than one investment bank together. So they all share that responsibility and it lowers the risk. Syndication is a very common practice for large amounts of transactions that represent large amounts of money. Commercial loans is another one that is very popular. IPO underpricing. So this is what happens. If you start with a stock price that is way too high for what the value of the company is, you are taking a risk that then you don't sell enough shares in order to get the capital, the target capital you have on your plan. So then you become undercapitalized. On the other hand, if you go too low because you're afraid that you might not sell enough shares to get the capital you want, then what you did, you just pretty much undervalued your company and leaving money on the table. It's pretty much what it means. You did not raise the potential capital you had. And the secondary market may benefit for those investors when they actually are able to sell at the proper value that was a little higher, but the company itself already missed opportunity to raise that capital. The announcements of new equity and the value of the firm. So this, it's more we call seasoned equity offerings. There's come in different names, but think of it as the same as an IPO, except that it's not initial. The company's already out there. They're just going to put more shares out there. Of course, clear difference is there's already more information of the company than there was with an IPO. An IPO is riskier for the investor. But the point is that the process somewhat similar, or the idea, the concept is similar. It's just putting more shares out there. So the market value of existing equity drops. Of course, you're putting more shares out there. If the company is about the same value, well, even if it's a little higher value, it just depends how many more shares you're going to put out there. Then it has to be spread across more shares, so the price will drop. Rights. A preemptive right is contained in the firm's articles of incorporation. The firm must offer any new issue of common stock first to existing shareholders. So because of what we mentioned here, that there's an expectation of the price to drop because of the spreading the value of the company across more shares. But then there's other problem where you will have less percentage ownership of the company when more shares go out there. So if you had 10% ownership of a company, they put more shares out there and other people buy it, you may go down to 8% ownership, 7% ownership. It just depends how many, plus the price drop. So what this is talking about is that they're about to, or they're ready to issue new shares, but there's a window of opportunity to where existing stockholders get to buy the stock. Typically, they get to buy it for a discounted price as an incentive to take care of your current shareholders. But then there's a limited time. So you're given the opportunity. If you did not take advantage of the opportunity, now it's your responsibility. Mechanics of right offerings. So the management of the firm must decide the exercise price, the price existing shareholders must pay for new shares. That's what I meant. They may get a special price. How many rights will be required to purchase one new share of stock? Okay, so if they're going to issue new stock and they allow current shareholders to buy, it's not just buy as many as you want. Somebody that has a large amount of shares, let's say 20% of the company, versus the other person has 10%, the person that currently owns 20% will have the right to buy a larger amount of the new shares than the person with the 10%. Dilution, you may have heard that term a lot out there. It does apply to a variety of things. Some are more prevalent or more common, but at the end of the day, percentage of ownership, shares sold to the general public without a rights offering. So as I mentioned, if you own 10% now and you don't buy any of the new shares, you're going to get diluted down your percentage of ownership. Now it says there without a rights offering. Yes, if there's no rights offering, it happens automatically. However, if there is a rights offering and you choose not to buy, you're still going to get diluted. Things that also fall under dilution but are less commonly spoken about. The stock price can go down because the firm accepts negative NPV projects. In other words, bad choices of the management. And then the stock price goes down. So really it's more of a dilution of the value versus percentage of ownership. And the same thing applies to the ones earnings per share can happen. Book values occur when market to book value is less than 1. This is a more complex situation because there's market sentiment involved versus the actual book value, which is historical. But nevertheless, as the market reacts to these differences, you might find yourself being diluted. Shelf registration. So not everybody can do this. Your company must qualify. In other words, you got to have a strong and good reputation. So what the SEC will allow you to do is to have a certain amount of securities to issue, but you don't have to issue them all now. This is the reason why. Let's say that you want to raise $100 million and you only need to issue so many shares or so many securities to raise that $100 million. However, you suspect that you may need more money, let's say in a couple of years from now. Well, if you do the process of issuing new securities over and over and over, each time you do that, you have to go through the whole costs that takes to do that. Versus if I was able to do one large one now, only use a piece of it and save the rest for later, then I can issue those later without having to go through the process again, and my costs will drop. So you save money. But so that would call a shelf. You put it on the shelf for later. And that way you don't have to go through the entire process again, saving you time and money. However, you have to be a good, reputable company. And I say securities because that can be done with bonds as well, not just stocks. Last but not least, issuing long-term debt. Think of bonds when we speak of this. All they're saying there, it's pretty much the same process and steps as stock. The security itself has a different type of characteristic of what it means to investors, but we're talking about the process to issue them and put them in the public, going through the investment banker out there, etc. If you're doing the first one versus doing a season one, as in more of the same, the process is pretty much the same. The security itself has different characteristics, but the process of getting it issued to the public is very similar. That's it for this video. See you on the next one.